Okay, hello everyone, and welcome to this episode of STA Open Call. STA Open Call is brought to you by the STA Foundation, a 501c3 corporation, which serves as STA's educational arm. Anything said on this call should not be considered investment or legal advice. Our only intention here is to provide some education. Today we're going to be talking a lot about the growth in equity private markets. So I think we all know that the growth in equity private markets has been remarkable over the past 2 decades. In fact, equity private markets have expanded at a faster pace than the public markets, and this is driven in part by institutional investor demand and also the emergence of technology-enabled platforms that connect companies with investors. Now, with conditions being what they are, companies are staying private. We read a lot about that as well. They're staying private longer due to funding conditions, favorable funding conditions, the desire for strategic flexibility, and obviously in the burdens of public market regulations. Now, understanding equity private markets today requires like an exploration of why companies are staying private longer, the distinctions between private and public equity companies, the growth trajectory of private markets relative to public markets, and the innovations in technology which replicate operational functions performed in the public markets. Now, here today to help us understand those 4 components and more in the general state of private equity markets is Brett Mock. Brett is the chairman of NASDAQ Private Markets International, where he leads the company's expansion efforts for its secondary liquidity solutions worldwide. He is responsible for creating new distribution partnerships with financial institutions across Europe, Asia-Pac, Latin America, and the Middle East. Previously, Brett was Senior Vice President and Head of Global Capital Markets at NASDAQ Private Markets, managing the broker-dealer, capital markets team, marketplace technology, and so on. So he has 30 years of experience in the industry as well. So we're really happy to have him with us here today to talk about the state of private markets and some of the things that are being done at NASDAQ Private Markets as well. So Brett, I want to welcome you to STA Open Call. Hope you had a great holiday.
Thanks, Jim. I think you missed the most important point. I'm a part of the family,
Yes.
STA past chairman.
Yes, he's in a very small club of STA past chairman. So thank you.
It's good to come home to the family.
Yes. All right, let's start easy. All right, let's start with why are companies staying private longer?
Yeah, I mean, you can throw in a whole recipe of reasons but you probably have a couple main ones. Number one, you touched on it really briefly, and I think we can get into that a little more in depth, which is just the pendulum of overregulation happening during the OOs, right? We had the dot-com boom and bust, and then we had a bunch of new regulations that we all lived through as equity traders, and then the great financial crisis. And so you got, some regulations that kind of made some companies rethink whether they want to be public. Then you throw in zero interest rate policy for a decade, so risk-free capital becomes much easier to get. And then as you get a recovery after the great financial crisis. So if you think about, we had the 90s dot-com boom, and then sort of post great financial crisis, we had the emergence of mobile phones, shared economy, which allows you to have like fintech and Uber and cloud and things like that. And so you did have innovation happening, but now you had companies, especially founders, entrepreneurs, that had other options now. They maybe didn't want to be a public company for all the reasons of the regulations, and they can get plenty of private capital. And I think we'll get into this a little more in depth because obviously the returns are something you really need to take a look at, because it's pulled a lot more investors into this market, which traditionally was mostly the VC growth equity crowd, but it's really changed in the last 10 years.
Mm-hmm. But what about just like the control and strategic flexibility that maybe the private companies get that maybe public companies, obviously they're always concerned quarter to quarter? Is that?
Yeah, I mean that you nailed it. I mean, if you're a C-suite at a public company, it's like you're getting a report card from your teacher every quarter, and if you get an A, you get a pat in the back and maybe a more pay. And if you get an F, if you put a couple of those in a row, you might get fired. So there's a short-term incentive for a lot of professionals, public company managers, to manages their company on the short-term quarterly reporting basis versus a private company where, if you're the founder, entrepreneur, if you're, early shareholder, and you're thinking about the next 5, 10 years, and you can get all that capital you need, and you've got, strong venture capital backing you or sitting on your board, you're not thinking about, in the next quarter. I mean, look at Elon Musk. I mean, he decided to go build rockets, and it's taken him 20 years. And SpaceX is now the most valuable private company in the United States.
Yeah. Yeah, no, yeah. So why don't we just talk about some of the differences though between
Sure.
the private and public equity companies, maybe like the ownership structure or some of the, I know you kind of touched on it before as far as the regulatory reporting and the regulatory requirements, but maybe talk about maybe some of the ownership structure and then some of the regulatory differences that are between the two types of.
Yeah. So these are, Reg D securities that are basically exempt from registration. And so that on the buy side means you've got to have QIBs, qualified institutional buyers, or accredited investors. And they have to sort of have the risk tolerance and sort of professional understanding of these being illiquid assets. That's something, frankly, that probably should change because as this asset class has gotten so much bigger, it should frankly flow into 401ks and pensions, but we can sort of put that on the table for a second and come back to it. But yeah, I mean, the private securities are really, exempt securities that are not registered, which means that they're not custodied, they're not held in street name. It's literally like the transfer of a title, like a house, like where you're literally like transferring the title of something over when you actually sell or buy. But the difference in this asset class to other asset classes is it's a trilateral settlement because the private company doesn't have to register these securities. They have the benefit of approving or not approving the transactions. So if they don't like the buyer for strategic reasons, maybe it's a competitor, maybe it's someone that maybe they don't want them in their cap table, then maybe they don't want them in their information rights, then they can block the transaction. And so you have a buyer and seller meeting, but then you also have the company basically approving or ROFRing, right of first refusal, or outright blocking the transaction. And that creates some problems because, I mean, Jimmy, you and I come from equity trading where if a buyer and seller agree on size and price, you're done. And in this market, buyer and seller agrees on size and price, and then you wait. And you could wait for 10, 30, 60, 90 days for the company to approve or not approve the transaction. And you and I both know the longer the trade doesn't hit the tape, the more risk you have of one party walking away, whether it's changing price or changing information. So you have some inherent inefficiencies in this market where even though you have buyers and sellers agreeing to transact something, you actually have to get the company to approve it. And given where NASDAQ private markets DNA came from was, working with the issuers. I mean, there's actually an article in the Wall Street Journal this weekend about us helping invent the modern tender because if you 2011, Facebook was sort of one of the first, decacorns to, come public at a large valuation, after being private for a decade. I mean, Jim, you and I both came up in the 90s and 2000s, and companies would go public after a couple of years to raise capital and would go into indices and go into mutual funds and ETFs and stuff. And now they're not, and I mean because they're staying private. And so Facebook was one of those sort of bellwethers that showed that a company can come stay private, be valued at a high valuation. And that's actually where NASDAQ and NASDAQ Private Market got really interested in helping sort of late stage private companies, really help them with sort of liquidity. And the analogy I love to use is that, when you and I both started in the business, we were, picking up the phone and clocking paper tickets and at the end of the day, looking over our blotters to figure out if everything matches up from an analog process. And so NASDAQ acquired Second Market in 2013 to really invest in infrastructure on a bet that more companies would stay private. And boy, did that bet pay off because between 2013 and 2023, VC-backed growth equity companies rose almost 600%. And the public equity markets maybe rose 100%, maybe. So you've had this paradigm shift. I mean, there were 10, 15 private VC-backed companies in the early 2010s. Depending on who you look at as far as measuring that, there's roughly 1,200 to 1,400 now, $1 billion venture capital growth equity-backed private companies in the world. If you count the number of listed equities, I think in the Wilshire 5000, I think it's 3,300 or something. So if you actually just look at that comparison, you've got what, 1,200, 1,400 billion-dollar companies, which would be a large cap stock today, that are sitting as private companies. And that's actually forced more and more professional investors to come over to the private side. And with the, ETFization, passive investing, fee compression, commoditization of research, and all these things, this asset class is a stock picker's asset class, because you actually don't have research really. You have to do your own, and you have to get to know the management of a company, and you have to have your own, fundamental fiduciary responsibilities as an investor. And so that's brought over a lot of the crossover mutual fund, hedge fund. They're now competing, actually, frankly, with the venture capital community for these assets. And it's global, meaning that it's sovereign wealth funds, it's family offices, it's international investors investing in these mid to late stage growth equity companies.
Mhm. All right, so I got like three follow-ups on what you just kind of talked about. One is there the trilateral agreement, that the buyer seller meets on price, but there's a third party here.
Yeah.
Has to approve, that has to bless the trade on that. Is there like a standard as far as like how that is it a committee? Is it like a board? Is it the CEO? I mean, like, is there a standard around who's making that decision?
No, and that's a great question, because that, although maybe is a bit boring in the weeds, it actually is really, really important, because you have no standardization. So you have to hire your lawyers, and you have to go to your board, or you have to work with your C-suite. And so each company is different. They have different rights. Board has to approve once a quarter. CFO has approval rights. Your stock admin, GC. So it just depends. It's all different documents. Remember, these are not, securities held in the street name or in the custodian. So literally, it's a physical title that usually is kept as a record in a cap table. And there's a couple of large cap table providers that have a big market share, like Card and ShareWorks, but there's actually like 32, I think, cap table providers. And what we're working on right now is technology to basically standardize the communication amongst these shareholder records, so that ultimately we can create a sort of one language that you can automatically update via, smart ledger technology and via API. So you're getting rid of the analog problem here of having to like work through email and PDFs and DocuSigns and all the manual paper process of trying to settle something. And we launched last year what we call TNS, which is transfer and settlement for private companies, where we do all the settlement for private companies. And that actually really, we give them technology, and we give them service, and we give them domain expertise, so that the stock admin and the GC and the CFO can actually do their day job, because this is like not something that they want to be focused on a daily basis. And they get, especially if it's a, large unicorn company that people want to own, they're getting constantly bombarded with this. So standardizing settlement is actually part of what our mission is we're trying to standardize a market, knowing that you don't have centralized custodians and you don't have DVP and street name securities.
Okay, the other question I have is, I was like getting ready for the call. I know I joked around before when we were talking that it gave me a chance to go back and read Sarbanes-Oxley from 2002, but some light reading over the weekend. But yeah, obviously, listen, every asset class, everything new that we have always has a moment of maybe a scandal. Obviously,
Yeah.
what I'm referring to is WorldCom and Enron, which was the primary catalyst for Sarbanes-Oxley. But when it comes to this space, like the only kind of like large scandal that I can think of, was WeWorks. Have there? I mean,
Well, sure. You're missing a couple.
Yeah, I mean, that's what I was going to ask you. Like, I feel like, are these like, what are some of the, have there been any big problems here?
Well, WeWork, you could argue was a scandal, or maybe it was just mismanagement, but it was, I think, the most valuable unicorn in the private markets by like 2017, 18. So that's debatable whether that was a true scandal. But I mean, FTX was the third largest private market company in 2021, and it was fraud. So that's absolutely a scandal. Theranos is another one where you had fraud and you had the founder go to jail. So there is risk, and there is a problem here where it's the return of capital, not return on capital problem, right? Where if you're giving money to a private company that's an illiquid asset, and there's no transparency, or there's no reporting requirements or nothing at all, yeah, you do run the risk of that. And that has to come back to your board of directors, the fiduciaries that are responsible for the company. And I won't get into what we think because we're not pro-regulation, but this asset class probably does need to have some standardization and some basic principles so that more investors that run pension money and savings and 401k can allocate say 135% to this asset class and participate on the upside, but also have the ability to have some ability to do some information verification so that you're not just believing what someone says and finding out it's all fraud. So that's I'll leave it to guys like you to help work with the regulators and that stuff, but it does seem like this asset class has gotten big enough. I mean, it's a $3.5 trillion asset class. It's bigger than the U.S. muni bond market as a comparison.
Wow.
So it's not a small asset class anymore. I mean, now U.S. equities are like 70 trillion, so it's still small relative to U.S. equity cash equities, but it's at $3.5 trillion. It's not small.
All right, so let's skip to some of the innovations in the space here. All right,
Sure.
that are fueling the growth. I mean, obviously, you kind of talked about no custody, but obviously these have to clear somehow, right? The securities have to be transferred in some efficient manner. So I mean, I guess like what are some of the operational functions that are involved with publicly traded companies that need to be replicated in private companies, and how is technology helping that?
Well, I mean, look, fragmentation is, not great for markets because you have no price discovery, right? Like, so we rolled out a product this year called Tape D, which is a play on two things. It's a play on Tape A, B, and C, and it's also a play on Reg D securities because there is no consolidated tape. So how do you know what the near real-time price is of an asset if you literally don't know? And especially if that company, raised capital, let's say 2, 3 years ago at some valuation that is no longer necessarily relevant. So as an investor, from number one, yes, you need to do your own fiduciary work, but at the same time, it'd be nice to know kind of what the market is, so to speak. More importantly than that, though, is the fact that the sellers of these assets are typically employees. And the reason that people work at private companies versus public companies is because they want the next SpaceX, they want the moonshot, they want equity to grow significantly, but it's going to be a vesting period over many years, and then they're going to have to wait to figure out when the liquidity happens. And so that's part of the problem here is that if the company's not involved with helping, that's what we do. Our core business is doing tender offers where the company's sponsoring liquidity programs. We're bundling together early investors and employees and running a process, movement of money, certificates, through in a fair and orderly process. But if it's individuals wanting to sell shares or investors wanting to sell portfolio positions, how do you value that asset, and what is the market, and what's the price of that? And why wouldn't employees, for instance, get the benefit of having some price discovery? Because this is kind of literally their compensation. And so in September, we launched in our second market platform a low fee, 1% fee, a direct access program where employees can post their shares in second market and be able to see some data and some price history and do it at a low fee rate when the average fee is 5% per side in this market. And so this market's migrating from sort of boutique brokers to more of global banks and larger institutions. As this asset class gets bigger, it's migrating to private banks, high net worth, family offices and stuff. But the sellers are really still the employees. And so providing more transparency for them through things like simple as a tape something is where you can actually look at the price of something and say, I gosh, I don't think I like that price, so I'm going to wait. Or gosh, that's a great price, I want to sell it. Because like today, you don't know that. It's old school over the counter, Jim, like literally from the 1980s NASDAQ, where you'd have to call around and see if you could get a couple quotes. And that's literally what it used to, that's really what it is right now in this market. And that's what we've changed here with the release of our second market in September is it's a global marketplace with banks and brokers, investors, and employees, and people can transact in a fair and orderly way through settlement.
Okay, well, that's great. What I want to tie into our last question here is around accreditor investors, but I want to kind of frame it in such a way that, there was an announcement last week that we're going to have a new chairman coming to the SEC, assuming that he gets through the Senate approval process. Paul Atkins will be the chair in 2025. General thoughts on Paul as a selection, if you have any, but then obviously more specifically, has he ever expressed any opinions on public versus private markets? I know he's expressed opinions on accreditor investors, so I'd like to kind of maybe get your thoughts maybe on that as well. So it's kind of like a three-part question. What are your general thoughts about Paul? If you have any, if you don't want to talk about it, it's fine. Are you aware of any insights or opinions he has on private versus public?
Well,
And then also accreditor investor.
yeah, I mean, I'll speak as a former STA chairman and as a
Good.
30-year practitioner, in capital markets and know Paul personally. I mean, I'm excited. I mean, I can't think of a more knowledgeable nominee for the new chair of the SEC that understands markets. And I mean, I think that's something in and of itself. And I mean, Jimmy, you spend a lot of time on the Hill and in the SEC is in your job. But I mean, when I did that as chairman, it was being able to talk about our industry and about how we have like this crown jewel in our country of liquid capital markets, which allows for innovation to happen, allows for a saving society to participate, in the growth of a country. I mean, we're savers. We invest in good companies and entrepreneurs like Steve Jobs and Elon Musk can get capital and build great companies. And that's having a market system with the pipes and the processes, the envy of the world. And I think a lot of times when we have crises, it's like the markets get blamed for it, and a lot of times it's not the listed markets or the within the infrastructure of the markets, it's outside. I mean, if you think about the great financial crisis as an example, right? Those are more like in the mortgage-backed securities and credit default swaps, not listed equities. But going back to Paul, I just feel like having him as a former commissioner, understanding markets is so beneficial, and bringing sort of that pendulum maybe back a little bit from where it's been in the last 4 years, given that it's been very, not I would say not pro market, to put it politely.
Yeah. Yeah, it's crazy. I went back and obviously I think a lot of people are reading some of his old speeches when he was commissioner back in the early 2000s. And I did read a couple of remarks that he made around the creditor investor. And to your point, listen, our capital markets, it's about capital formation, turning ideas into multi-billion-dollar companies. It's also about wealth generation. And it's about it isn't just the company, their ability to have access to capital, but it's also the ability for citizens to buy into these companies and enjoy it in their success and stuff. And it's funny, in some of his speeches he was dead right on some things and dead wrong on a couple others, but I think on this one he was more right than wrong, just talking about the standard for a creditor investor and how it's going to deny some people the opportunity for wealth generation. But we'll leave it there. But I got to tell you, this was I do appreciate you coming on and talking. I know a little bit over where we usually go, but this is a big topic. It's a big topic. This market is developed, and we have a lot of change coming in our industry and in the marketplace. And before I wrap it up, is there anything that you want to maybe talk about that I didn't bring up on this thing? Is there anything you want to say, or did I?
No, I mean, I just maybe wanted to say, I mean, thanks for all the work you do for STA, Jim. I mean, it goes without saying that you're our advocate in front of DC. No matter who's in the White House and no matter who has the majority and minority parties, you're always there representing our industry, which I I know how hard that is and appreciate it. So thank you for that. I'm obviously STA is as a past chairman, I'm a big believer, but thank you for doing these talks too, because I don't know that everyone, like, they hear SpaceX or maybe they hear, a couple other private companies, but they don't realize the magnitude that this market has grown in the last 10 years. And it was really from overregulation during the OOs, and then of course having, new technology and having some pretty low risk capital that, and then allowing, really this innovation economy to think long-term growth. They don't have to think about short-termism. They're thinking about long-termism. That's actually a good thing, right? We get amazing new sectors, and we're in, I guess the thing I'll leave you with is, I've been lucky in my 30-year career to sort of ride a technology wave, right? I mean, .com, cloud, sort of Web 2.0, and now we're in the AI era. And so the next 5 to 10 years of Web 3.0, not to mention whatever blockchain, that infrastructure that blockchain is going to create with smart ledger technology, like, we're in a substantial cycle here that's not going to just be cyclical. It's going to be secular. And so it's super exciting to see what innovation actually comes out of that. But this is to the benefit of our, the United States and our country, is that we have this entrepreneurialism, we have this innovation, and we're building the tools and building the right model to let that incubate and grow.
That's great. Well, I'll leave it right there. All right, so thanks again. Thank you
Thanks, Jim.
thank you all the STA supporters and listeners. This is going to be our last call, our last open call for 2024. So with that, I'm going to wish everyone a happy holiday, happy New Year, safe travels wherever you go, and we'll see you in 2025. Thank you.